Welcome back to the Ellis Martin Report on MoneyTalk Radio. I'm Ellis Martin. Today I'm speaking with Gregory Patton, Chief Financial Officer of Prairie Operating Company, trading on the NASDAQ as PROP, a Houston-based energy company with operations in the Denver-Julesburg Basin of Colorado. Greg, welcome to the program. Thank you so much for joining me today.
It's great to be here, Ellis. Thanks for having us.
If you don't mind, give us an overview of Prairie Operating Company.
Sure, Ellis, not a problem at all. Prairie is a publicly operated oil and gas company located in the heart of the DJ Basin in Colorado. We are primarily focused on the exploration and production of hydrocarbons in a very clean and efficient environment here in Denver, Colorado. It's a beautiful place to live. It's a beautiful place to operate, and we take that to heart. Been in the basin for well over 15 years now and live here, have friends that live here, and take pride in the fact that we produce a very clean molecule of oil and gas in the DJ here. And one of the things that we pride ourselves here at Prairie is the fact that we've continued on a lot of those efforts that have been exhibited by prior operators, and we're really influenced by the governing committees here in Colorado to ensure that we can cohabitate as a business provider, providing resources to the greater populace, as well as provide jobs to the local workforce. And so at Prairie, we've carried on a lot of those traditions that many of us, as we've aggregated together and started and formed this company, members from Chevron, members from Oxy, members from presiding Great Western Petroleum, PDC, and just to name a few of the larger ones that you may be familiar with here in the DJ. As we've aggregated that group together, we've brought all those values into Prairie and build it out. And so to give that build out and a little bit of history, timeline behind the significance of Prairie, Ed Kovalik and Gary Hanna, our two founders, throughout the COVID process came together, and we'd like to do an oil and gas company. We'd like to put it together, start from the foundations. And they wanted to do that in a manner that was public so that there was access to the capital markets, first and foremost, so that it was not the normal private equity backed model, and gave us a little bit more flexibility to be able to go aggregate, consolidate, and build something that was really a little bit different. I kind of reference this back to like an era of RSP Petroleum, Parsley Energy, Rice Petroleum. The innovation that was pulled together by the members that put those entities together were very insightful. They were different. They were small. They were dynamic. They were growth oriented. And that's something that we really had instilled in us by our founders, Gary and Ed, as we kind of built this from the ground up from 23 forward. So if we rewind and we looked at some very detailed specifics of that, there was the original acquisitions that really started the foundation and asset base for Prairie in 2023 that moved into the negotiation and the close of the Nickel Road assets in 24. And then again, late 24, moving into 25, the negotiation and close of the Bayswater acquisition, which we are still yet to post-close at this moment, but we're getting very close with the company per the TSA agreement. And that was really the foundation for the transformative change in going from a company operating 20 wells, roughly 50,000 acres, to now well over 60,000 acres, operating north of 300, almost 400 wellbores at this point in time, with new production coming online, and really a transformative story to grow into this entity that has all the values deep ingrained in us that we've been able to accommodate and collaborate together with the team that we've built out. Kind of give you a rough overview of the company.
That's a great overview of the company, actually. In 2 years, you've managed to scale up to 21,000 barrels of oil per day, which is amazing in 2 years. And now you're headed towards 100,000 barrels of oil per day. How do we get there?
You know, Ellis, there's multiple ways that we can get there. That's the dynamic aspect of a growth-focused E&P entity. And so I'll go through a couple of those high level. Number one, first and foremost, is organically. We do it through the drill bit. So we have a very capable team. We focus on costs. We focus on efficiencies. We put as many wellbores in the ground as we can that are allowable by the state through our permitting process, which regulates us and gives us kind of the confines as to where, what's approved, how we can develop organically. And the state has become a partner with us over the past couple of years. If we rewind back to 2018, 2019, there was a lot of commotion in the DJ Basin. And I'd like to touch on this for a quick moment because things have changed in the DJ. We've built an alliance with the state, with the governing bodies here, and we've built that alliance so that we can cohabitate together. And again, I come back to that clean molecule. I come back to that cooperation in efficiencies and effectiveness. And that has allowed us to procure permits, to develop efficiently, and to put a lot of well bores away here in the DJ. It's a very prolific area. So organic development is first and foremost how we're going to grow into that 100,000 barrels a day. And we can do that through a growth rate. And that growth rate can vary depending on zone, depending on how we drill, depending on how we're timing our cash on cash returns. And we have a very mindful note to those cash on cash returns because we want to stay under levered. We want to stay in the good graces of our bank group. We don't want to overgrow and outspend too quickly and get ourselves in a predicament. So we're going to be very focused on that. Number 2 is acquisitions. And as we've looked at the DJ in particular, our focus, our home, where we're keyed into for our development strategy and our acquisition strategy, we've seen a lot of consolidation. We've seen Oxy take out multiple different competitors here. We've seen Chevron come in and take out multiple other competitors here. And what that has done is it's aggregated very large acreage positions for them, and it's created opportunistic opportunities for us to go in and work with them and identify areas that may not be key resources for them for the next 2 to 3, let alone 10 years. And we can go in, talk to them, build a relationship with them, and potentially partner in the future. And that's the same with the Civitases of the world, as well as for dads, the Bisons, etc. And so as we look at the aggregate of operators here in the DJ, they've done a lot of consolidation. And now we're looking to participate in that consolidation aspect as well. Some of them may be large, some of them may be small. The small ones are equally as beneficial to us. I'll point to our recent Edge acquisition that we notated in the Q2 financials, as well as we'll be releasing a press release on here very shortly. It hasn't been released in regards to the close of that Edge acquisition, which provides additional incremental inventory to us. It's a contiguous acreage block that provides us operational excellence and ultimately helps us build that robust story of heading towards 100,000 barrels a day. Number 3 is kind of one of those clutch aspects of how the company is structured today, and that is we're public. And that public aspect provides opportunities for potential other private equity investors that are maybe long in the tooth in their investment to utilize us as a vehicle to consolidate, merger of equals, whatever nomenclature you'd like to use there, to combine us in a nature that would allow us to continue to grow, provide them a vehicle to potentially exit via a public stock over a period of time. Obviously, depending on the size of the deal, there would be lockup provisions, so forth and so on. But it just provides a unique other opportunity that many other private to privates don't provide each other. And so we're really excited about all 3 of those opportunities. And again, just to recap, the organic development through our drill bit, acquisitions on a one-off basis ranging in size, and potential mergers in the future. And so to answer your question, Ellis, that's how we would grow to 100,000 barrels a day.
Thank you. Are you finding that adjacent landowners in the area are reaching out to you, seeing the success that you're already having?
To answer that in twofold answer, yes, they are. In areas that we are operating, they absolutely are. But what I'd tell you is ultimately we're a new name in the basin. We've been doing community events to show our name more, and those have been highly rewarding to us. Some of those have been the Weld County Junior Livestock Auction. We've been involved in Weld County Schools, Weld County Food Bank, and those things have done more for us getting our name out in the community because ultimately, keep in mind, we acquired assets with a different named operator on them. And as we drill and complete our own organic wells, which we'll be notating that we'll be bringing on here shortly with some new pads, our name will get out there in the community more prolifically. But at this point in time, we're getting most of our named aspects from those community events. And that's highly important to us to be involved in those community events so that we are ingrained with the community. So we build good reputation with the landholders and leaseholders, and that we continue to support the community as well. And like I mentioned, Junior Livestock Auction, the food banks, schools, and any other areas that we can really participate in, whether it's a fun environment like this Greeley Stampede, which is a great event held every year in Weld County. We just want to be part of the community because that's ultimately what kind of completes that whole circle of business, exploration, and pulling it all back to community and environment.
How are you prioritizing capital allocation between drilling, acquisitions, and potential share buybacks?
So when we look back of the Bayswater acquisition, we were able to acquire that asset at what we believe was a win for both the seller as well as for us as the buyer. We've done some work in and around that asset that's incrementally increased the value of that to us, i.e. aggregating some acreage, utilizing locations that were available to us on pre-existing permits to develop other acreage blocks. And so it was a highly accretive acquisition at a good multiple. As we think about those multiples and we think about how you're acquiring assets and whether we look at that on a PV basis, which is present value, the kind of nomenclature is a PV 10% discount to the present value, kind of an oil and gas nomenclature there. Ultimately, we've been able to acquire much higher valuations to the company across all of our deals in terms of the production we're buying, whether that be a PV15, PV17, PV20 on some of these acquisitions that I've mentioned. So as we think about prioritizing, they will always be in mind of our investors. They will always be in mind of being able to have an aggregated approach to valuation uplift. They will always be mindful of having additional inventory. We don't want to just grow to grow production. Growing production can be done by buying PDP, getting other investors involved that are PDP focused. And while PDP is an important part of our model, always having additional upside associated with how we're developing is equally as important to us. So again, I'll kind of summarize that down just a little bit. How do we prioritize which acquisitions we look at on a go-forward basis? It's going to be value-based. It's going to be where can we add the most value to shareholders? It's going to be how can we optimize that acquisition? Is there any additional value we can add to it? And then lastly, is it contiguous and does it make sense with our current acreage block? Meaning, we don't need any additional infrastructure of a significant form. We don't need to think about an additional pumper that may be too far from his current route. All of those factors are highly focused upon and looked at before we make any allocation of capital towards acquisitions. And so hopefully that gives you a little bit of better idea of how we look at acquisitions. We're going to look at them all, but they're going to be highly focused as to which ones make sense for us.
Well, let's flesh that out just a little bit. You've executed about $600 million in off-market acquisitions in just 2 years. From your vantage point, Greg, how do you evaluate whether a deal is accretive and financially compelling?
Great question, Ellis. And, as we look at that, we have built out a great team. We'll come back to the team environment, built out engineering, geology, land, production management, operations in the field with very qualified individuals. Again, I'll mention the names again: Civitas, Oxy, Chevron, Great Western. We've brought and they aggregated this team together. And so I'm going to rely upon that team. I'm going to rely upon my engineers. I'm going to rely upon the data that they aggregate together, which is based off historical representations throughout the basin, aggregated together, pulled into a database. Database puts out the materials that I need for my team to pull a financial model together. We're going to look at it in that level and granular aspect of detail on every deal that we do. And so as we look at those valuations, as we look at the value it brings back to the company, we're always going to risk it. We're always going to ensure that there is upside for our investors, that there's upside for the company, and that we're making the right decision, not necessarily a decision that makes us look the best, but we're making the right decisions, because ultimately you can make an acquisition of an asset that makes you look good for a short period of time. And this is the long game for us. We're not about a short reactive acquisition to make it look better. We're about a long-term acquisition that makes a play for us to develop into the future and build value, not just make it look good.
The company's mentioned that you're planning to begin returning capital to shareholders through dividends. What's the timeline and what milestones need to be achieved before that happens, Greg?
Ellis, dividends are a great way to reward your investors, and we're obviously focused on getting to shareholder return in a quick manner. To answer your question directly, leverage is important. Ensuring that you have ample liquidity is important. That you've become cash flow accretive is important. All those factors are important into a dividend program. As we think about dividends in the future, it's absolutely in our foresight, and we will continue to pursue ensuring the company builds up to those metrics that are required in order to pay that dividend. And it is first and foremost on our insights and goals as we move forward.
You've managed to reduce well costs from over $7 million to about $5 million. How are these great efficiencies showing up up in your numbers, and do you see more room for cost reductions?
Efficiencies of scale are a great thing. As we've ramped into a full rig, full frac crew type program, we've been able to effectuate those efficiencies, which leads to bottom line savings and returns. So yeah, those numbers are coming together. Those numbers are realizable. Those numbers are actual. And as we think about how we can effectuate that more on a go forward basis, scale again is another way you can do it. Aggregation of buying in bulk is another way you can do it, which requires a little bit more scale than we may have today. But ultimately, we're really happy in and around that $5 million marker. And maintaining is equally as important. A lot of vendors will come to you with a great deal for the first 6 months, and then they want to juice their returns. And so managing those vendors is going to be the number one largest priority for the company. And we've really put the skill sets in place to do that, both in the ops team as well as in the finance team. And so as we look at how that moves on a go-forward basis, we will be highly focused on ensuring those costs are low, ensuring that we maintain those levels of execution so that we can continue to deliver the returns that we get when we produce a well that has cost us in and around $5 million to drill, to complete, and bring online.
I have so many more questions, and I guess we're going to have to do a follow-up interview, but really I'd like to know how you came to the company. Tell us about your background. You're not really only a CFO, you're a planner.
No, absolutely. You got the name exactly right there. So my background started in public accounting. I was a bean counter, and I can't say that I would have wanted it any other way. Loved accounting in college, got a graduate degree in accounting from the University of Denver, met a beautiful lady, love to call her my wife. Devin's been beside me my whole career, and ultimately we've maintained our family here in Denver, and I'm so thankful to have been able to do that and raise 2 beautiful children here in Denver. But as we think about where my career has led me, it's taken me multiple different areas. So after leaving Ernst & Young in the public accounting world, I went to Opportune, which was a phenomenal opportunity and a great learning environment. Josh Sherman, partner there, who's still there to this day, and I have done a lot of work together. We took multiple companies public: RSP Petroleum, Parsley Energy, Rice Energy, Eclipse Resources, just to name a couple. And there was a host of others. There was almost 14 of them that we worked on together in different capacities over a period of about 5 years. And I got to experience what it was like to see a startup go from 4 people in an office working around a conference table to building out a multi-billion-dollar enterprise over a period of 4 years, and got to see that repeat itself multiple times. And it gives you the itch. So I had the opportunity with Great Western in 2014 to come in-house with them. And that kind of fixed a family issue, which was I was traveling, I was on the road, I was all across the United States for the better part of 4 years. And so going and working at Great Western, while I was still a consultant at Opportune at the time, gave me the opportunity to get a little bit more ingrained in-house, not just be the consultant. And after about 6 months with Great Western, they asked me to join them full time. I took the opportunity. I spent the better part of 7 years with Great Western, where built a great relationship with the owners as well as with the management team, and got to really understand how the business was run. And I'll tell you, consultants, we didn't have a clue. There's so much more goes on once you get inside. And it's always been about the learning and the exposure and the experience. And so getting to learn and understand the real inner workings of an oil and gas company, getting ingrained in the DJ Basin here in Denver with other operators, building the rapport that I have today, gave me a great foundation and skill set. So I thank you to Tom Mandula, who hired me at Great Western, as well as for the opportunity to continue to work there with Rich Fromer over the years. Rich is on our board now. And so, these relationships that I continue to reference and bring back around, it's prevalent and it's important, because ultimately knowledge is a key to success. And having people you trust, knowledge base that's available to you, someone to always not only help you achieve your goals, but question how you get to those goals is equally as important. Keep you on your toes. And so as we kind of move through the sale of Great Western in 2022, I took a little bit of time to myself, spent it with my kids and my family, been a pretty busy period of time over the past years. And then I had the opportunity to go work for a private equity-backed service company based out of Casper, Wyoming, and help them restructure, wind down a little bit, and ultimately had the opportunity to come here to Prairie in the midst of that. And it was just too good of an opportunity to pass. It was right down the path of what I had seen before in 2011 and 12 with RSP, Parsley, Eclipse. And it reminded me a lot of those times. And I took that opportunity. And to circle this back to planning, and exactly what you said. I was brought on as the SVP of Corporate Development here, which is a planning type role. It's acquisition based, it's planning based, it's development based. And that's really where my role has been focused over the past 15 years. Even as I was in public accounting, I was always auditing the budgets. I was always the person that was looking at the capital forecasts. And so I've really gotten ingrained in those processes. And I had the opportunity here at Prairie to take that role. Really love that role, continue to succeed in that role. And Craig Owens was a great CFO for us. He moved on and retired to spend time with his wife. And Ed Kovalik and Gary asked if I'd be willing to step into those shoes. Big shoes to fill. Still working on them to this day, but it's been a great opportunity to move into the CFO position. Obviously, career aspirations nonetheless, but they're big shoes to fill. Making strides here now, building out a team. Have a great team behind me at Prairie and the accounting departments, finance departments, planning departments. And so really excited about the future to come.
Well, Greg, I want to thank you for your time today. This has been fascinating. And listen, we've got to come back and visit again soon. There's so much more I want to talk to you about. Thank you so much for joining me today on the Ellis Martin Report and Money Talk Radio.
Thanks, Alice. Appreciate the time as well.
I've been speaking with Gregory Patton, CFO of Prairie Operating Company, trading on the NASDAQ as PROP. For more information, visit prairieopco.com. For Money Talk Radio and the Ellis Martin Report, I'm Ellis Martin.
This segment has been paid for by Wynn Group Holdings, LLC. Forward-looking statements have been made. Invest at your own risk.